Welcome back, Voyagers. Today we will look at the financial budgets and cost models used in the control of purchases. But before we dive in, don't forget to subscribe to our channel and hit the like button for more entertaining educational videos. Alright folks, let's demystify financial modeling and ratios using everyday scenarios that you can relate to. Financial modeling. Think of this as planning your monthly budget. You know you have a certain amount of money coming in, and you want to figure out how to spend it wisely over the month. Just like you plan for rent, groceries, and fun activities, companies use financial modeling to plan how they'll use their money in the future. Now, one of the tools we use in this magical journey is financial ratios, and they're like secret spells that help us figure out if a business idea is a good one. 1. Return on investment, ROI. This one is like deciding whether to buy a new phone. You consider how much it costs and how much money you'll save or earn by having it. If the benefits outweigh the cost, you go ahead and buy it. 2. Return on capital employed, ROCE. Imagine you're lending your bike to a friend. You want to know if they're using it effectively. ROCE is like checking if your friend is making good use of your bike. If they're riding it all the time and taking care of it, that's a good sign. 3. Profitability ratios. Think of these as your lemonade stand earnings. You calculate how much money you're making after you subtract the cost of lemons, sugar, and cups. It helps you see if your lemonade business is making you a nice profit. 4. Liquidity ratios. Picture your piggy bank versus your IOUs to friends. Your piggy bank is like your cash, and your IOUs are like the money you owe. Liquidity ratios check if you have enough cash on hand to cover your debts, just like making sure you have enough money in your wallet to pay back your friend when they lend you some. Now let's simplify financial budgeting. Financial budget. Think of this as a plan for your allowance, but for a whole year. It shows how much money you'll either earn or spend. Now there are 3 important things you do with budgets. 1. Planning. Imagine you're planning a big family trip. Before you go, you need to figure out where you'll go, what you'll do, and how much it will all cost. Businesses do the same. They create a financial plan, budget, to decide where to spend money and when. It's like planning your trip itinerary. 2. Controlling. After you've planned your trip, you keep an eye on your spending. If you notice you're spending more than you planned, you need to adjust and maybe skip a fancy dinner. Businesses do the same with their budgets. They compare how much they're actually spending to what they planned. If they're spending too much, they make a plan, action plan, to get back on track. 3. Decision-making. While on your trip, if you realize you've saved money on transportation, you might decide to treat your family to a nice meal. Businesses make decisions too. If they see they're spending less in one area, underspending, they decide what to do with that extra money. It's like deciding to invest in something new or save it for later. Now let's break down the cash flow cycle. 1. Receive raw materials and components. Think of this as buying the ingredients for a cake. You get the flour, eggs, and sugar, which are like the raw materials and components for your cake. 2. Manufacture products. Now, you mix those ingredients and bake the cake. This step is like making the actual product from the raw materials. 3. Store and inventory. Imagine you have a shelf in your kitchen where you keep the cake. Businesses do the same. They store their products until they're ready to be sold. 4. Pay suppliers. Just like you pay for your ingredients, businesses pay for the raw materials and components they use to make their products. 5. Sell products. You take your cake to a bake sale and sell it. Businesses do the same, but with their products like phones or clothes. 6. Receive funds from customers. At the bake sale, people give you money for your cake. In business, customers pay for the products they bought. And here's the cool part. After step 6, you go right back to step 1, just like baking another cake for another bake sale. The cash flow cycle keeps going, with businesses repeating these steps to keep their operations running smoothly, just like you keep baking cakes for your bake sales. Now let us discuss the difference between services and goods. 1. Inventory and timing. Think of a restaurant versus a furniture store. In a restaurant, the chef can't prepare meals in advance and store them for customers who might come later. They cook when you order. But in a furniture store, they make the furniture in advance, store it, and sell it when you want it. 2. Tangible versus intangible. Consider a smartphone, manufactured product, and mobile data service, a service. You can touch and feel the smartphone, but you can't physically touch the data service. You experience it through your phone, but it's not something you can hold. 3. Production and consumption. Picture a car manufacturing plant versus a hair salon. Cars are made on an assembly line and then sold when they're ready. In a hair salon, the service, haircut, is provided as soon as you sit in the chair. The production and consumption happen at the same time. 4. Variety from the same base. Think about a software development company. They have a team of developers who can create different types of software, like apps or websites, using the same skills and resources. It's like offering various products, software solutions, from the same base, development team. 5. Customer interaction. Consider a hotel stay versus buying a washing machine. In a hotel, your experience and satisfaction depend on how the staff interacts with you. It affects whether you'll come back. When you buy a washing machine, you don't interact with the manufacturer, you just use the product. Let's simplify other financial terms with real-life examples. 1. Revenue. Imagine you run a lemonade stand. The money you make from selling lemonade is your revenue. It's the total amount of cash flowing in from your lemonade sales. 2. Direct costs. Think of your lemonade stand again. The cost of lemons, sugar, cups, and other things directly related to making and selling lemonade are your direct costs. These are the expenses directly tied to your product or service. 3. Overheads. Now, picture the expenses that aren't directly linked to making lemonade, but are needed to keep your stand running. This could be the rent for your stand, electricity, or the wages of your lemonade stand helper. These are your overheads, the ongoing cost to keep your business going. 4. Depreciation. Imagine you bought a fancy blender for your lemonade stand. Over time, it loses value because it gets older or wears out. The decrease in its value is like depreciation. It's the reduction in the value of assets, like equipment, as they age. 5. Bank loans. Suppose you need some extra money to buy a bigger lemonade stand. You might borrow money from the bank. These loans are like a temporary allowance from the bank that you'll pay back later. 6. Investments. Think of investments as putting your lemonade stand earnings into a piggy bank. Instead of spending all your profits, you save some for future growth or emergencies. It's like making your money work for you by investing it wisely. 7. Dividends. Now imagine you've saved a lot of money from your lemonade stand, and you want to share some with your friends who helped you. The money you distribute to them is like dividends. It's a portion of the profits paid out to shareholders, like your friends, in a company. Let's simplify the advantages of budgeting and budgetary control. Advantages of budgeting and budgetary control. 1. Planning for tomorrow. Budgeting is like creating a roadmap for the future. It makes managers think about what they want to achieve, breaking it down into detailed plans for each part of the organization. 2. Teamwork and communication. Think of a well-coordinated orchestra. Budgeting encourages different departments to work together, like musicians playing in harmony. It promotes teamwork and keeps everyone in sync. 3. Clear responsibilities. Imagine a soccer team with each player having a specific role. Budgets assign responsibilities to managers, making it clear who's in charge of what. It's like defining who plays which position on the field. 4. Performance measurement. Budgets are like scorecards in a game. They let you measure how well you're doing. If you're not scoring as expected, you can investigate why, like reviewing a game's plays. It helps in evaluating performance. 5. Taking corrective action. When you see your team losing a game, you'd adjust your tactics. Similarly, budgeting allows you to take action if things aren't going as planned. 6. Motivating the team. Picture your team celebrating a goal. Involving employees in budgeting can be motivating. It's like getting everyone excited and engaged in the game plan. 7. Resource efficiency. Think of budgeting as making sure everyone has the right equipment and training for the game. It ensures that limited resources are used where they'll have the most impact. 8. Time saving. Instead of constantly monitoring every small detail, budgetary control focuses on exceptions. It's like watching the game and only stopping to review specific plays that need attention. So, budgeting is like strategizing for a big game, ensuring everyone knows their role, working together, and keeping score. It helps you plan, measure, and adjust for success in the future. Let's simplify the concept of price and quantity budget variances with examples. Let's say we budgeted for 7 pizzas, each priced at $10. However, in reality, we ended up purchasing 6 pizzas, but they cost $12 each. The total variance is the sum of price variance and quantity variance. In our case, the budget was calculated as 7 pizzas $10 each, which is $70, while the actual spending was 6 pizzas $12 each, which is $72. In our example, we spent $2 more than our initial budget. Let's break it down in both the price and the quantity variance. Price variance. The price variance is like checking if we got a good deal on our pizzas. It's calculated as budgeted price minus actual price multiplied by the actual quantity. So for us, it's $10 minus $12 multiplied by 6 equal minus $12. This means we overspent our budget by $12 because the pizzas were more expensive than we expected. Quantity variance. Quantity variance is about how many pizzas we actually bought compared to what we planned. It's calculated as budgeted quantity minus actual quantity multiplied by the budgeted price. In our case, it's 7 minus 6 multiplied by $10 price, which is equal to $10. This shows that we bought 1 pizza less than planned and saved $10 because of it. Other budget variances could be labor variance, overhead variance. Thank you for joining us on this thrilling journey. Subscribe to our channel for more entertaining and educational videos. Please don't forget to hit the like button if you really enjoyed our voyage. May your future endeavors be as exciting and successful as our adventure today.